So, you've poured your heart, soul, and probably a lot of late nights into your business. You finally apply for that loan to really kick things into high gear, and then you get the email or the letter. That one single word, denied. And wow, it can feel like a total gut punch, right? Like a verdict on your entire vision. Let's break down what that really means.
And it absolutely feels personal. It stings. You feel like they just looked at all your hard work, all that struggle, and just said nope. It is a super frustrating, discouraging moment for any business owner. But here's the secret the banks don't really tell you in that vague rejection letter.
What if that denial isn't a dead end? What if it's actually a set of directions? Because, rejection is just information. It tells you exactly what a lender is looking for, and it shines a spotlight on where you need to focus your efforts. So let's take that frustration and turn it into a solid plan.
Okay, to get approved, first you have to understand why you were denied in the first place. This means we have to get inside the lender's head a little bit, see your business the way they see it. It's less about your passion and way more about their process.
Here's something you've got to understand. Traditional banks, they aren't investors looking for the next unicorn. They're risk managers. And you know what they crave? Predictability. They want boring. A business that makes 10 grand every single month is way more attractive to them than one that makes nothing for 11 months and then 200 grand in December. They basically operate on a checklist, and they're just looking for a few key metrics. All right, first up is the big one, your personal credit score. For most traditional banks, 680 is pretty much the floor. Honestly, a lot of them want to see something north of 700. To them, that number is a shortcut for how reliable you are. It's not personal, it's just their number one tool for measuring risk. Next, they want to see that you've been in the game for a minute. That 2-year mark is a classic benchmark. It tells them your business isn't just a fresh idea, it's a proven concept that has survived those really volatile first couple of years. You could be 18 months in with profits through the roof, but that strict 2-year cutoff might still get you a no. And finally, revenue. I mean, this is kind of obvious, right? They need to see consistent cash coming in the door to believe you can actually handle a monthly loan payment. A really common threshold is at least $10,000 in monthly revenue. It just shows your business has the financial muscle to take on new debt without collapsing.
So, yeah, those 3 numbers are the big ones, but they're not the whole story. Let's quickly run through the most common reasons for denial. Poor credit, they see a high risk you'll default. Unstable revenue, that screams inability to make consistent payments. Insufficient history, to them, your business is just unproven. A high debt ratio, that suggests you're already stretched too thin. And a lack of collateral, well, that means there's nothing for them to take if things go south. The key is to figure out exactly which of these was on your denial letter. Okay, so you've decoded the no. You know what the problem is. Now your roadmap kind of forks into 2 very different paths. The first path is to fix the issues and go right back to those traditional lenders. But this time, you're ready to play their game and meet their criteria. If you're going this route, here's your checklist. First, read that denial letter like a detective. Get the specific reasons. Second, double-check your original application for any dumb mistakes. A simple typo could be the bad guy here. Third, and this is a big one, pull your credit reports from Equifax and TransUnion and dispute any mistakes. You'd be surprised how many reports have errors that could be dragging you down. Fourth, if your debt was the issue, start paying down what you can. And finally, when you reapply, you can bring a stronger case. Show them updated documents, maybe bring on a cosigner, or even just ask for a smaller loan to show you're serious. But what if you don't have time for all that? I mean, who has 6 months to rebuild their credit or just wait around to hit that 2-year mark? This is where our second path opens up. The key difference is what these 2 types of lenders actually value. Traditional banks, they're looking at your past, your credit history, how long you've been in business. But alternative lenders, they're focused on your present. They care way less about your FICO score and way more about your real-time cash flow. They want to see revenue and performance, not just a long history. So let's talk about path number 2, the alternative route. This path is for businesses that are healthy, that are generating revenue right now, but just don't fit into that boring and predictable box that the big banks love so much. A really popular option here is a merchant cash advance, or MCA. Now, this isn't a loan in the traditional sense. It's an advance on your future credit and debit card sales. A lender gives you a lump sum of cash, and then you pay it back with a small fixed percentage of your daily sales. This is awesome for retail shops, restaurants, or anyone with consistent card sales because the payments go up and down with your revenue.
Pretty smart, huh?
Another really powerful tool is called invoice factoring. If you're a B2B company and you're always stuck waiting 30, 60, even 90 days for clients to pay their bills, this is for you. You basically sell your unpaid invoices to a factoring company for a small fee. They give you most of the cash right away. So you're turning your receivables into immediate cash without actually taking on any new debt.
Or what if your company's value is all tied up in its physical stuff? That's where asset-based lending, or ABL, comes into play. It lets you get a loan by using your equipment, your inventory, or your real estate as collateral. With ABL, the strength of your assets is often way more important than your credit score. It's all about unlocking the hidden value in what your business already owns. So why even go this route? Well, the advantages are pretty clear. Approvals are incredibly fast. We're talking 24 to 48 hours sometimes. The requirements are way more flexible. Some of these lenders will work with credit scores as low as 600 or with businesses that have only been around for 6 months. And that the paperwork is usually minimal. They're focused on your recent performance, not your ancient history.
So, we've looked at all the reasons for denial, and we've explored 2 very different paths you can take. Now, let's bring it all together. Let's build a concrete plan of action. This is about moving from feeling rejected to feeling totally empowered. Here it is, your plan, simple and actionable. 1. Diagnose. Get that denial letter, pull your credit reports. You have to know exactly what the problem is. 2. Organize. Get all your financial documents together in a clean, complete package. Sloppy paperwork just screams sloppy business. 3. Strategize. Decide which path is right for you. Are you going to fix things and appeal to a traditional bank, or are you going to find an alternative lender? And 4. Research. Don't just apply everywhere. Match your business, your industry, your revenue to the right type of lender for you. At the end of the day, a loan denial is not the final word on your business. It's just feedback. It's a fork in the road. It forces you to get smarter about your finances and more strategic about how you get funding. So the real question isn't if you'll get funded, but how. Which direction are you going to choose to keep your business moving forward?